Hello, good morning. Today we are going to see cost of preference capital. So what is preference share capital? Preference share capital they are having a preferential right over what getting dividend and repayment of capital at the time of winding up. So in these two regards, they are having some preference over other shares. Other shares means the ordinary shares or the equity shares. So that is why these are known as the preference share capital. Okay, and in the case of preference share capital, you get a fixed rate of dividend. The dividend is fixed and it cannot vary. It is not based on the amount of profit that you earn, but a fixed rate of dividend is fixed. Okay, and at the inception itself it is fixed, and that will be paid periodically. And in this case, you see two types of preference shares. One is the irredeemable and next is the redeemable. Irredeemable means during the lifetime of the business, you are not going to give back. So those are perpetual preference shares, or those won't be repaid. Only at the time of winding up, you need to pay that. So that such preference shares are known as irredeemable preference shares. So in that case, always the cost will be denoted by K. And in the case of preference shares, it will be denoted by KP. That is equal to D by NP. D is what? Dividend, and NP is net proceeds. Now, net proceeds we have already seen. That is what you get out of that issue. That is known as the net proceeds. So if it is issued at par, you will get the full amount. If it is discount, if it is a discount, then you will have to deduct the amount of discount and find out the net proceeds. If it is at premium, then you get more money and the net proceeds will be more. So that will be face value plus premium. So here it is quite simple. That is D by NP. Just divide dividend divided by net proceeds. So what you give out, that is dividend, and that you can divide by net proceeds, and you will get the cost of irredeemable preference shares. Okay, so that will be, you will get it as a percentage, and you can multiply with 100 and you will get it as a percentage. And next is the cost of redeemable preference shares. So cost of redeemable preference shares means those shares are redeemable. That is, in after a certain period of time, you're going to repay that. So that is why redeemable preference shares. So in that case, what they are getting back is not just the dividend, but it's the difference between the realizable value or redeemable value. Redeemable value means when you are going for redemption, what you get back. Suppose 100 rupees preference shares, you are getting back 110. That is redemption at premium. Then redeemable value is more. But NP, we have seen at the time of issue what you got, whether it was at par, at premium or discount. And so that is why I told, in the case of redeemable preference shares, sometimes there can be a difference between redeemable value and the net proceeds. So in that case, you will have to count that also into consideration. That divided by N, because this you are getting for a fixed period of time, maybe for 10, after 5 years, if you are getting back the amount, then that the difference will be divided by N. Okay, and so difference divided by N divided by, you are finding the mean or the average of redeemable value and net proceeds. So average value you are taking, that is why half you are taking. Okay, hope the formula is clear. So cost of preference shares is dividend plus what else? The difference between redeemable value and the net proceeds. Okay, and now we'll see that is a problem. That is the first one is irredeemable preference share. So you are not taking the value of so in this problem, how will you know that whether the shares are redeemable or redeemable? So in the case of redeemable, the realizable value or redeemable value will be given. So in this case, it's not given. So you can take it as what? Irredeemable. So the first formula you will be applying. So cost of preference shares is equal to dividend by NP. So dividend is, you are going to find out the dividend. This is the number. Always remember, if it is not given as rupees, then that means you will have to multiply with the face value. Okay, so 20,000 into 100 is the par value of that. Always you will be paying interest as well as dividend on preference shares, interest on debentures and dividend on preference shares on the face value only. Okay, so whatever may be the net proceeds, you don't have to worry over that. You will be paying on the par value or the face value only. Okay, so 20,000 into 100 into 12% is the dividend. So dividend came to 2,40,000, and here you can see cost of issue is given as 2 rupees per share. So that is applicable in all the cases, and that is cost of issue. So that is in all these cases you incurred a cost of rupees 2 per share. The issue cost of these shares. So flotation cost. So that is cost of issue is 20,000 into 2, that is 40,000. And let us see what is this is the net proceeds given for the first case if it is issued at par. So then if it is issued at par, this is the face value which we have already calculated, minus 40,000. Even though the issue was at par, you lost 40,000 as what? Issue expenses. So you got only 19,60,000. So that is the net proceeds if the shares are issued at par. And dividend is going to be the same, 2,40,000 only, because that is all I told you, that is always calculated on the face value. Okay, so 2,40,000 divided by 19,60,000 into 100, that is 12.24. And if it is at a premium of 10%, the dividend is again the same, and you will have to calculate this 20 lakhs into, you can calculate as 110%, or separately you can calculate 20 lakhs into 10% and add it together with 20 lakhs. So you will get it as 22 lakhs. But from that also you will lose what? The cost of issue, which is the same 40,000 per share. That is 2 per share. So it is 40,000 only. So dividend 2,40,000 divided by 21,60,000 into 100. And if it is at a discount, here again the dividend is the same, but here it is at a discount of 10%. So straight away you can calculate as 20 lakhs into 90%, or find out 10% separately and deduct from 20 lakhs. So you will get it as you will get a value, and again you will have to deduct 40,000. So you will get it as 17,60,000. So see here the net proceeds changes. Here it was, even though it was at par, you will have to deduct the issue price. Here it was at premium, but then also the amount is more here, and still you will have to deduct what issue price. Here also you will have to deduct the discount and the issue expenses. Okay, so you will get the cost of preference shares. Now the second question is in the case of redeemable preferences. So see here I told you, that is redeemable after 5 years at a premium of 10%. Clearly it is given. So that is, it's a case of redeemable preference shares. Okay, so you will write the formula, which is, I told you, not only dividend but plus the difference of these two divided by n. So for a year you are finding out. That is, suppose after 5 years you are going to get 110, and now you issued at 100. So 10 rupees is the difference in the prices. But 10 rupees divided by 5 years, what is the number of years that you will have to divide? So for a year you will get. That is why you are doing this. Okay, and so this is never d by half of this, but it is d plus the difference in this capital gain also, divided by half of, you are finding the average value. So this is quite clear, but you should understand why this is done so. Okay, that is why I explained. And then you will have to just substitute and find. And here rupees 100 is the issued price, and this is the when you are redeeming, you are giving an extra amount of 10%, and cost of issue is also given. So net proceeds you have to deduct 2 per share. So what is the amount of dividend? So find out the par value. Always dividend at par value. 5 lakhs into 10 by 100. 10% is the dividend, and you got 50,000. And 50,000 is the dividend. Now we are finding out the difference between the redeemable value and the net proceeds. Redeemable value is how much? The face value is 5 lakhs. 5 lakhs into 10% you will give, no? So 5 lakhs into 110%, or find out separately 10% and add it. So 5 lakhs 50 minus what is the net proceeds. So 50,000, 5,000 into 2, that is 10,000 is the issue cost or the issue expenses, 10,000. So 5 lakhs is the par value minus what? Issue expenses, 90,000. 10,000. So you will get it as 4 lakhs 90,000. Hope this is clear. Net proceeds is clear. 5 lakhs minus 10,000 issue expenses. Divide by 5, because within 5 years, after 5 years you are paying back. So 5 years. So this amount. So here, even though you are getting 60,000, 5 lakhs 50 minus 4 lakhs 90, 60, no, 60,000. 60,000, but that is for 5 years. So 1 year you are finding out the amount. Okay, that is why you are dividing by 5 and half of this value, and you will get it as 11.92. Hope both the cases are clear to you. Can practice more problems, and then the concept will be more clear to you. Okay, thank you and have a nice day.